right, welcome everyone. I'm excited to be here for this panel on stocks I love. My name is Adrian Pocobelli. I'm the host of the Northern Miner podcast. And just thanks to Jay Martin and Vancouver Resource Investment Conference for having me. It's been it's the first Vancouver Resource Investment Conference I've ever been at, and I have to say I'm totally impressed. So joining me today is Lobo Tigre, a well-known newsletter writer, the writer of The Independent Speculator, and also Nick Hodge, who is beside me here, who publishes Digest Publishing. And so I'm really thrilled to have you both on here, and so welcome. So I guess, with a title as we have it here, let's get right to it in terms of, I think you'd come to an event or an event like this in order to figure out how you could get some alpha, as I would say. So, Lobo, I know you don't give away specific companies, as you told me before the show, but what sectors are you interested in the resource sector, or even in general, as independent speculator, the writer of The Independent Speculator?
There's different ways we can slice this and dice this. Let's just start with commodities, and maybe later we can look at company types. But right now, my universe as a commodities speculator is pretty narrow. I like gold, silver, copper, and uranium, and that's it. Nothing else right now, not even oil. I get it, but there's so much turbulence ahead. We've got Trump shock today, starting now. Nobody knows what will happen. In an uncertain environment like that, I like the monetary metals. I like copper because of structural supply constraints and relative cheapness compared to the others. And I like uranium because you need it basically no matter what. I can't think of anything Trump would do that would send uranium south. So in terms of things that I'm loving right now, it's anything based on those four metals.
Interesting. And just before we turn to Nick, it sounds to me like that's a bit of a kind of a recession-proof kind of play. Is that what you're aiming at here when you look at those sectors?
Yeah, that's a smart thing to pick up on. I think of this, particularly the two yellow metals, as a self-hedging portfolio. If Team Soft Landing is right, Powell kisses the boo-boo, and Trump doesn't upset things too much, everything is fine. Maybe my gold and silver, my safe haven assets won't do so well, but it'd be great for the economy. The uranium stocks should go, do really, really well in that environment. If the opposite happens, the world gets even scarier. Trump really rocks the boat. My gold stocks and probably silver stocks should do really, really well. Who knows what will happen to energy, including uranium. So in a way, it's a self-hedging portfolio.
Okay, beautiful. And Nick, as the writer of Digest Publishing, what are you excited about in terms of sectors? And I think you can talk about stocks if I'm not mistaken. If you can't, that's okay. Where are you excited right now? Just in general, but I assume that this is resource oriented, but what's exciting you in terms of places to buy stocks?
Sure. I think uranium is at the top of the list for me as well. We'll have a uranium panel right after this with a couple of other individuals. I've been a uranium bull for a long time. It had a really nice consolidation in 24. It was sort of a weak year for the metal. I think the chart looks really good, and I think a lot of catalysts have come to fruition in the past year with all the AI things. Russia banning export of enriched uranium, softness out of production out of Kazakhstan. So I think a lot of catalysts there lined up and agree that we're going to need a lot more energy for these data centers over the next couple of years. So I think uranium is at the top of my list as well. I go down and I look at the list of companies that I made here. Precious metals is at the top as well for obvious reasons, right? You're in a gold bull market. Silver's likely going to follow and have a couple of good years. So I look in that space as well. And then, two more, I guess. Lithium is a contrarian play right now. It's come all the way around from 10,000 to 80,000, back down to 10,000, right? So, Rick Rule's line is either contrarian or fictive, right? So now's the time to be looking at the long-term positioning and rebound of the lithium sector. And then the sector I presented on yesterday is sort of the intersection of technology and resources. And I know the gentleman that was just presenting on the stage was talking a little bit about that, but we feel like we missed out on a lot of gains with crypto and AI stocks running. And, we're starting to see these worlds collide, not just with uranium, but I was talking about battery passports the other day, right? There's a real need for the digitization of the mining sector to get all this data online, emissions data, tracking for supply chain things that are going to go into metals contracts in the future. And so those are some of the areas that I'm looking at.
Yeah, I find that a super interesting area. As a matter of fact, I was interviewing Jay about a month ago, and what came in the conversation was this idea of, maybe AI and the sensors and basically new technology to a certain degree disrupting the exploration sector, which is a very notoriously expensive sector. You put the drill in the ground. Is that kind of what you're getting at here? Like if we were to kind of rephrase it to a certain degree, like a kind of technological disruption of exploration?
There's multiple ways, as Lobo said, to slice it. So one is the tracking of the supply chain, right? Or to concentrate the emissions, the fuel used, all that sort of stuff, verifying that you're actually getting the metal. We still see painted rocks get delivered. I mean, those headlines are still happen in the 2020s, right? So that's one aspect of it. And then, so sort of two things. New exploration technology, Typhoon, Cobalt, those kind of things, right? We just saw Cobalt raise money in a $3 billion valuation. So that's one thing. And then extraction technologies as well, right? With Newton and Jetty and SIBO and the sort of new extraction technologies that are coming online. I think all that is fertile hunting ground.
And just final follow-up on this. How do you play that? Like, I mean, Newton, isn't that a Rio Tinto? Can you buy Newton as a stock? Or?
No, but you could have bought Aldebaran, which we financed at 30 cents in 2020, and Newton came in, and we didn't know that was going to happen, but Newton ended up coming in and giving a fair amount of capital. We'll give them more over stage payments when they hit certain milestones, and that stock is, it's up 600% from the 30 cents refinanced at AB, right? It's outpaced the copper commodity, it's outpaced the copper ETF, and so there's other companies out there you can research if you go to the Newton website that they're partnered with, right? Like Arizona Sonoran, for example, and there's others, but that's how you would play it, the companies that are leveraging that technology.
I mean, it is kind of the exploration company investor's dream to get that, 600% returns. Lobo,
Sorry, before we move on from that, let me
go for it. Take it away.
Parade here. That's my thing. Right now, the parade. I just want to say, beware of science projects. I'm all in favor of the modernization we're seeing in mining. There's some things that are just no-brainers. If you can send a robot scoop tram into an area where it would be dangerous for humans, that's great. It can save costs, it can save lives. I'm all for progress, but beware of science projects. And there's been a lot of excitement about AI helping mining, and I haven't really seen a lot of delivery on this. Like any of these things, it takes time to go from the exciting new idea to the proven commercially viable, successful product. So just beware. When you hear somebody out there saying, oh yeah, AI is going to make our new gold discovery or whatever, just take that with a bucket of salt.
Indeed, wise words, Lobo. A great disclaimer, as a matter of fact. So you mentioned uranium, for example. So how do you play this? I mean, traditionally, I think we could see, exploration stocks are seen as a kind of leverage on, say, the, extreme leverage, so to speak, on the uranium price, and say there's the big cap, so where, you'll do well. Traditionally, you do well, but maybe not as well as the explorers. But I think in recent years, sometimes this has, not always been the case. I don't know, maybe the gold sector. I think we have examples, right, where sometimes the bigger companies will do better because maybe they're seen as safer, they're generating cash. So all to say, how do you approach, say big cap versus medium or small cap? How do you diversify?
So that's not just a uranium question. I think this is actually a really important thing, because a clear trend that we got from 2024 was that a rising tide in multiple commodities did not lift all ships. And in the past, it's kind of worked that way. And it's, the typical wisdom of the business is, there's a commodity rallies, the major producers go first, then the mid-tier trickles down, and eventually the rising tide lifts all ships. That did not happen last year. And to the degree that even the majors moved, there was a huge distinction. If we just take gold, for example, the majors that actually did a good job, you know who I'm talking about, right? Their stocks went up 52-week highs, multi-year highs. The majors that fell on their faces or had political setbacks, they didn't do so well. So we look at the average of the GDX, and it barely kept up with gold. That's not what we're here for. But if you're a stock picker, and if you didn't just buy the index, but you bought the companies that were known for operational excellence, you outperformed. And I think this is really important for us. What is 2025 going to be like? I think it's a risk now to assume that the rising tide will lift all ships, even if we do get a rising tide in uranium or whatever. So whether you are more comfortable in the major producers, supposedly safer bets, or whether you want to swing for the bleachers on a junior, an exploration play, I think you need to be a stock picker. You don't want to just bet on everything uranium running or gold or whatever. You want to bet on a specific company that has a deliverable in your investment time frame that you think has not just a chance, but a better than 50-50 chance of delivering in your time frame.
Okay, excellent. And, talking to Rick Rule, I believe he said, he puts in, was it 4 hours, I think maybe a week, or for each company that he invests in, a certain amount of time. And so how do you think retail investors, what do you do? I guess you do this, full time, so to speak, right? But how should the retail investor, let me phrase it this way, maybe the average retail investor shouldn't be buying exploration stocks, one could argue, right, because of the high risk that's involved. How should retail approach exploration?
But you should know that you're taking that risk. There's nothing wrong with evening. If you like going to Vegas, if you like gambling, why not? But you need to understand that you are gambling. This is not investing. Graham Dodd's securities analysis doesn't apply to the mining sector as a whole. It's just the underlying commodities are too volatile, and on top of that, you've got company, variables that just don't work here. But I do have a rule of thumb like VRICs that I think is very simple to remember. If you have companies in your portfolio, however many you have, you should be able to immediately identify what the company is talking about when you get a press release. If you get a press release and it says, oh, we drilled this on XYZ project, and you're thinking, XYZ, which one was that? You probably have too many stocks in your portfolio. You should, whatever's the right number for you, it has to be a number that you can keep on top of. If you're not being able to track what's coming your direction, you're spread too thin.
Interesting. So just to summarize to a certain degree, you think retail should be reading the press releases?
Oh, yes, absolutely. And it's funny, I just did a recording on this with Jay's Commodity University. And I know there's a lot of techno-gook in there, all this geochemistry and all this stuff. And if you're not a chemist or you're not a geologist, it's tempting to just close your eyes and I don't understand all this. But you can invest a little time, 80-20 rule, right? You can invest a little time to understand a lot here, and you should. This is not a get-rich-quick scam. If you're not willing to do at least a minimal amount of work to understand what you're speculating on, you are asking to be roadkill.
Fascinating. And Nick, do you have anything to add to that? Or
Similar sentiments. We're both newsletter writers, right? You can pay someone to analyze press releases for you. You can subscribe to services that do that. Shameless plug, resourcestockdigest.com, where we have clients that sponsor corporate clients that sponsor us, and my partner Jordo interviews them when they have press releases that come out. So there's lots of services like that. But I would say the same thing Lobo said. You've got to be willing to do the work. And if you're not, it's sort of a know thyself thing, right? I think ETFs are okay if you're not willing to put in that work. And then if you are, that there's plenty of newsletter writers, plus your own due diligence, that you can do to scale down in the sector. I guess, carrying on with uranium specifically is, you mentioned it, people like these sort of mid-tier producers, right? The Dennisons of the world, the Energy Fuels of the world, because they're liquid and you can get in and out. And uranium specifically is a very small sector, right? So I like to think of Hotel California. It might be easy to get in, especially via private placement, which we tend to do. But you might not have the liquidity to get out when you want if things change on a macro level, et cetera. So those are the thoughts I would have.
Yeah. Okay, excellent. And I don't want to lose sight of the title of this presentation, and you have some stocks. So I guess start with what you're excited about, or maybe we talk about uranium, but really if you have other stocks you'd rather be more excited about, like that you're more excited about, tell us about those. excite us.
Yeah, I mean, I don't know how many stocks you want or what you're looking for, and again, there's different risk levels, but what I write about in my letters and what we're all about sort of Digest Publishing is eating our own cooking, and so just to prepare for this workshop here, I just looked at my portfolio and saw what I own sort of the most of, and one of the companies is Kingsman Resources. A tiny company about to drill in Chihuahua, Mexico on a past-producing asset that was mined by Asarco in the 1940s. It's super high-grade silver. This is an exciting district, right? Recent acquisitions, Los Gatos, for example. Kingsman is a very tightly held company, something like 23 million shares out. They own a royalty that they could sell for likely $1 million on Gogol's nearby project. And so a lot of things to like there. It's a fairly new story. Just about to get drilling, hopefully in the next, 4 to 6 weeks, something like that. So catalyst ahead, and positioned right, structured right, so that shareholders can participate in the upside if they have success with the drill bit. So, that's one of them.
Okay, excellent. And is the general thesis that it's undervalued right now versus basically what they're actually doing, and that the market is not, basically understanding what's happening? Or is it something that it just looks so great?
I think it's the latter. What is valuation? Trump coin is valued at $70 billion or whatever it is, right? Is that overvalued? I don't know. So, let's talk about the excitement factor. You're still seeing that drill holes, exciting discoveries, high-grade drill hits are getting rewarded. Everybody saw the Mark hole the other day. Hopefully you saw TDG go up commensurately with that via closology. And so I think it's exciting, and it's not appreciated, and it's not well known because it's a fairly new equity, right?
Right, and just to follow up on this, remember James Dines, of course, he had this idea that, ultimately you would have these stocks that were, like, say, silver. Let's say you'd have a stock, if it was below $20, it was basically worthless what was in the ground, and then once it went above $20, all of a sudden you had a mine, so to speak, and so you get tremendous leverage where it'd go from worthless to a mine. Lobo, what do you think of that? Is that how you think of it ever, or do you have a different philosophy?
Well, yes and no. The price fluctuation isn't enough. If we were just talking about this on the copper panel, if you have a known deposit that's been looked over, passed over for decades because it wasn't economic, and now copper prices are up and we're all excited, well, guess what? Your input costs are up as well. If it wasn't economic before, and now your energy costs are up, your steel, your tires, everything is up, the price fluctuation alone is not enough there. But you said something else. If you're making a transition, if you're going from exploration to production, the pre-production sweet spot, that's one of my favorite types of speculation. You're literally transitioning from pouring money into holes in the ground, reverse circulation or diamond drill, to taking money out of a great big hole in the ground, the mine. And logically, there is a market revaluation there when you do that. And the data is very strong on that. There are some really good gains available in the pre-production sweet spot. In terms of other things that I'm loving right now, I always love the pre-production sweet spot. I love that transition. If you want to benefit from the earlier part of the Lassonde curve, though, exploration is so difficult. Not even Rick Roll and Doug Casey, they don't know who's going to make an exploration. They have this huge big shotgun and they can buy all these things and the big wins amortize the losses. But there is a different way to play that. Well, there's two. One is, if you want to go early stage, I really like prospect generators. I'm not going to name any names, but when you have a basket of prospects paid for with other people's money, you have many kicks at the can and you don't dilute the heck out of your shareholders, and that gives you time to wait for discovery. So in my view, that's, if you want early stage Lassonde curve, to hunt for 10 baggers, the prospect generators are the way to go. If you want something with a more shorter time frame, then there's what I call success in progress, and that is you give up on the discovery hole. Nobody knows when that's going to come. You come in after the discovery hole. Between there and defining your first 43-101 resource, there's a lot of success there that does result in higher share prices. So I like that part of the Lassonde curve too.
Okay, excellent. And just in our closing minutes, a couple of minutes here, Nick Hodge, do you have a philosophy of selling? I think so many people, myself included in the past, we've written up these investments and then we write them back down because we think they're going to go and take care of us forever. I mean, do you have some practical advice for investors on how to sell, which is, I'd argue, harder than buying?
Yeah, it's much harder than buying, and sometimes you forget to do it. There's a couple of things I like to do, and other newsletter writers like to do as well. So I try to get a negative cost basis in some of my stocks. So I take some off the table along the way, and I lower my cost basis in that stock. So when I look at my portfolio now, many of the equities I own have a negative cost basis. In fact, I've paid myself to own them. That's more about taking gains and lowering your cost basis. An easier one to do is when something changes, right? If the management told you one thing and the story changes, they don't have success, you don't want to get on that treadmill of having to pivot with them all the time, right? And it's going to take more time, it's going to take more capital. If the thing you invested in that company for changes, I think you should change your positioning as well. And I have to say, it's funny you mentioned Mr. Dines, because he was a friend of mine, and when he passed away a couple of years ago, he actually graciously left me his newsletter list. And so those folks who read the Dines letter are now subscribers at Digest Publishing, for sure.
Well, that's social proof if I've ever seen it. Thank you, Nick Hodge of Digest Publishing and Lobo Tigre of The Independent Speculator. Thank you for sharing your insights today with us.
Yeah, thank you.